The Black Swan Event. Quite possibly the scariest, or the best, thing in the worlds of finance and economics. And definitely something that we should all be aware of. Today we're going to be talking about what the Black Swan Event is, as well as its close cousins, the Gray and White Swan Events. We'll go over possible solutions to it and what you can personally do to protect yourself from it, and possibly even become stronger because of it. A lot of stuff to get through today, so let's get started. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So first and foremost, what is a Black Swan event? According to Nassim Nicholas Taleb, author of the book The Black Swan, The Impact of the Highly Improbable, and Fooled by Randomness, among other works, a Black Swan event is a highly improbable event with three characteristics. It's unpredictable, in the sense that the event was an outlier because nothing in the past can convincingly point us to the possibility of such a thing occurring. A Black Swan event carries a massive impact, which can be either positive or negative. And after the fact, and with the benefit of hindsight, we can concoct an explanation that makes it appear less random and more predictable than it really was at the time. Some examples of a Black Swan event include sudden market crashes, such as Black Monday, which occurred on October 19, 1987. On Black Monday, the Dow Jones Industrial Average fell by a whopping 22.6% in the span of a single day. That sort of one-day loss was an extreme outlier, given that the next largest drop, at least in terms of percentage, was a 12.8% drop, which occurred on October 28, 1929. Other crashes like the dot-com bubble and housing crisis are often mentioned by Taleb as Black Swan events as well. These events are not to be confused with Gray and White Swan events, which each have their own definitions. A Gray Swan event is a highly probable event with three characteristics. It is predictable, it carries an impact that can easily cascade, and after the fact, we again concoct an explanation that recognizes the probability of occurrence but shifts the focus to errors in judgment or some other human form of causation. Examples of potential Gray Swan events include the impacts of climate change, population growth, and the rising national debt. They're Gray Swans and not Black Swans for a few reasons. First, we are aware of their presence. Second, we know that any of them could possibly cascade into something with severe and wide-ranging consequences, up to and including another Great Depression-like era. However, third, and perhaps most importantly, even though we know about them and their potential ramifications, hindsight might eventually reveal to us that we didn't take them seriously enough today. And as a result, the narrative surrounding these events, again, should they actually come to pass, will be about our own human error and indecision more than anything else. A White Swan event is an event that's considered to be almost certain to happen. Beyond its near certainty, it has two other characteristics. It carries an impact that can be easily estimated, and after the fact, we concoct an explanation that recognizes the certainty of occurrence, but again, shifts the focus to errors in judgment or some other human form of causation. Examples of White Swan events include taxes that we have to pay in order to keep our societies functioning on their current standards of living, additional healthcare costs with engaging in activities that we know to be unhealthy, such as smoking, and so on. So again, Black Swan events are unpredictable before they happen and have massive impacts when they occur, whether positive or negative. Gray Swan events are foreseeable before they happen, but their impacts are not easy to estimate beforehand because they can cascade and become more wide-ranging than we would anticipate. And White Swan events are near certainties, whose costs can be estimated with relatively good accuracy. So now that we know what a Black Swan event is and what it isn't, what's the solution? What can we realistically do about it if we can't see these events coming beforehand? Well, people have provided many possible solutions to the issue. Here are a few of the most popular ones. The first solution is to build your investment portfolio in a very conservative manner, only choosing investments that are traditionally not volatile, such as treasury bills, which theoretically limits your exposure to negative Black Swan events. However, there are a couple of things to consider with this type of strategy. First, Black Swan events are characterized by being incredibly rare and unpredictable. It's true that traditional measures show that T-bills are less volatile than many other investments such as stocks. However, they are not necessarily immune to Black Swan events. Treasury bills are guaranteed by the full faith and credit of the government's Treasury Department. However, countries do collapse. I mean, it is rare, and America collapsing in the next few years would be exceedingly improbable, but that doesn't necessarily mean that it's outright impossible. And second, investing most, or even all of your money in low-risk, low-return investments can limit your exposure to a potential positive Black Swan event. I know that so far I've been focusing more on the negative Black Swan events because they usually get the most coverage, but these events are often very random, and as we know, a random event is just as likely to be positive as it is negative. Take Bitcoin, for example. Before it began gaining wider recognition, it would have been very difficult to predict the run that it went on through most of the 2010s. But for those who got in on or even near the ground floor, experienced a tremendously positive Black Swan event, and may very well have made millions from that one experience. The internet and its effects have been another Black Swan event, both in the positive and negative variety, depending on how you want to look at it. But anyway, getting back to the solutions. The second solution to Black Swan events is to take an extremely speculative approach to your investments. The idea here is that if most or even all of your investment portfolio is made up of speculative, high-risk, high-reward investments, you're much more likely to eventually hit on one that pays you enough to retire in comfort. And while that may very well happen, I mean, we saw it with Bitcoin. Hypothetically, if you invested $1,000 a month in Bitcoin in January 2015 and sold at the height of the bubble, you could have easily had almost $1.5 million in your nest egg. But that assumes a few things. First, it assumes that you managed to buy into something that has a run-up similar to Bitcoin at the right time. Second, it assumes that you manage to sell at the right time. And third, it assumes that you don't then pour some or all of that newfound fortune into another speculative investment that loses most of its value in the future. So don't get me wrong, it's definitely possible to do it, and some people have done it, but it's also a Black Swan event, albeit with a positive twist. But by definition, a Black Swan event is rare and unpredictable, so it isn't necessarily the most likely thing to happen. And if you don't manage to hit on one of your speculative investments in time, or if you do but lose much of your fortune in a future speculative investment, you may not have enough money to support yourself the next time you really need it. Now, I should note that with some of these investments, you can ensure, to a degree anyway, that your losses are capped at a certain amount by either insuring them or putting in a stop-loss order for your investments that automatically sell if they fall to a certain price. But the risk of loss still remains. The third potential solution to Black Swan events is to become what Taleb calls anti-fragile. There are 3 states that you can exist in when it comes to reacting to randomness, as well as Black Swan events. You are either fragile and get broken by these kind of events, robust and don't really care much about these kind of events, or anti-fragile, and you get stronger because of these kind of events. From an investing perspective, to truly become anti-fragile, I think we actually need to look beyond just our investment portfolios. There are things that we can do to make ourselves more robust to the stress of systems, such as stop-loss orders like I just mentioned, and there certainly are some systems that actually benefit from stress. You need look no further than medicine or our own biology to find examples. And there are some types of investments that do better with volatility than others, and diversifying your portfolio to include some of those may help, but I think we can and should go a step further. So beyond just diversifying our portfolios, beyond building some redundancy into our own financial systems, what we can do to help ourselves become more anti-fragile is to diversify our knowledge base, income streams, and skills. If we can diversify our incomes, preferably with some sort of business or side hustle that we can run ourselves, we're less likely to be totally destroyed by a sudden and unpredictable job loss. It'll still hurt, no doubt, but we'll have a much better chance at making it through, and perhaps even becoming stronger for it, if the additional time that we're able to spend on our business or side hustle, due to the fact that we, no longer have a 9-to-5 job, allows us to grow our income to a point that meets or exceeds what we were making in the traditional workforce in the first place. If we can diversify our knowledge base, we're going to be better equipped to make good decisions in those uncertain times, or at least just less likely to make decisions that we will later regret. And we may have more doors open for us when the conventional ones appear to be closing. Not to mention, we'll likely be perceived as more valuable to our employers and will be less likely to be laid off in a downturn, all else being equal. The same can be said about our skills. And to show you just how much of a difference this can make, let's take a look at John, Jane, and Bob. Bob graduated high school at 18 and began working as a laborer immediately after that. Every day he went into work, did his time, and went home to binge watch various shows on Netflix, which would be all fine and good if he did that once in a while, but if you do it every day for years, it might come back to bite him, as we'll see in a minute. John graduated high school and went on to college to study accounting, since it was a safe, steady job that provided a good paycheck. Jane went to school for business and entrepreneurship, since she felt that learning how business works while making networking connections and gaining the skills to run one herself someday, should she so desire, would give her greater flexibility than most jobs out there. She doesn't initially start a side hustle, but she does maintain those connections to the entrepreneurial world and continues to learn about various industries that she's interested in. Not necessarily to cover herself in the event of a black swan, but just because it interests her. Just to keep things incredibly simple so that this video doesn't drag on too long, let's say that John, Jane, and Bob all save and invest $500 a month. And we'll say that there are 3 different investment options: stocks, bonds, and gold. Stocks average returns of 10% per year, bonds average 4%, and gold 3%. With the exceptions of the years where the market crashes. And no, I'm not basing this off of anything in particular, I'm just making up these percentages as I go along to try and keep things simple and to illustrate the point. Bob invests his money evenly between the 3 investment options. John puts 60% of his money in stocks and 40% in bonds, since that's what his advisor recommended. Jane was confident in her ability to find, or create, an income for herself in the event of a market downturn due to her education and entrepreneurial connections. As a result, she was comfortable putting 100% of her money in stocks. 5 years later, the economy experiences a major crash, the likes of one which we haven't seen before. The stock market craters, losing 75% of its value, with the first 30% drop occurring on the first day of the crash. We'll call this Black Monday 2.0. Bonds do better than stocks, rising by 20% during the year, and gold similarly does better than stocks, but doesn't do quite as well as bonds in this case, rising only 10% for the year. As a result of this economic crisis, John, Jane, and Bob all lose their jobs. John is out of work for just 1 year before managing to find another job as an accountant. Jane is without enough income to maintain her savings for 3 years, but it's partly by choice. She could have taken another management job after a year of searching for work, just like John did with his accounting job, but she realizes the importance of diversifying her income streams, now more than ever, and honestly she feels there's no better time to take a risk than right now. Thankfully, she's kept up with her entrepreneurial interests and her colleagues. Therefore, she contacts her business friends and launches an online publishing company. By the time the 3 years have passed, the company has grown enough that she's able to save her $500 a month again. However, due to the scalable nature of her business, and the fact that it's grown enough for her to work part-time as a management consultant if she wants to, she will be able to increase the amount she saves each year by $3,000. Unfortunately for Bob, he's the least fortunate of all. He didn't invest in his education or his skills, traditionally or otherwise, and as a result, he doesn't know how to successfully diversify his income streams, even if he wanted to, and he doesn't have the skills that are considered marketable in this damaged economy. So unfortunately, the reality is that he's only going to be able to find temporary and part-time work during the entirety of this market crash, which we'll say for the case of this hypothetical example will last 5 years for Bob. The good news is that he manages to keep his head above water financially during this time. He just doesn't make enough money to save anything. At the bottom of the crash, Bob looks like he's actually in the best position, with a net worth of almost $28,000. John's not too far behind with a net worth of $21,000. And Jane is the worst off of the 3 with a net worth of just $9,000, which is what we'd expect given that all her money went into the stock market, which just had a crash. Thankfully for Jane, she studied finance enough over those first 5 years before the crash to understand that while markets may take a tumble from time to time, they generally do come back into the green eventually. So she doesn't sell her investments at the bottom and isn't so scared off by the crash to avoid investing in stocks once her business gains enough revenue for her to be able to start saving again. John is similar to Jane in the sense that he keeps investing in stocks, but he does lower the amount he puts into stocks down to 50% of his savings. The 10% that he's no longer putting into stocks will go into bonds, so now he's investing 50-50 between stocks and bonds. Bob is completely against investing in stocks as he feels they're way too risky. So he starts investing 50% of his money in bonds and the other 50% in gold once he gets back to working full time. 10 years after the market fully recovered from the first crash, we are rocked by another Black Swan event. Massive, unpredictable, and uncontrollable hyperinflation. The US dollar has collapsed and the entire country is in turmoil. Now, before we go any further, I want to reiterate this is a grossly oversimplified and 100% made up example for the purposes of displaying how becoming as anti-fragile as possible beyond your portfolio instead of just in it is important. There are many people who have written or spoken about what would happen to various asset classes and the world as a whole if the US dollar collapsed. They all have different theories, but we really don't know what the full ramifications of such an event would be, or even if we will see such a thing happen in any of our lifetimes. So again, I just want to emphasize this scenario and the returns in it are entirely made up, and I urge you to just focus on the overall concept behind the example and whether or not you feel the idea of anti-fragility beyond just your investments is worth pursuing. Okay, back to the example. The dollar is more or less worthless, and as a result, virtually all of the savings that our friends have built up over the years are worthless as well. In addition to that, John and Bob lose their jobs once again. Jane's income as a management consultant may dry up as well, but in theory, at least part of her publishing business income will remain, as there may be people overseas that still buy some of the work that her company produces. A new currency eventually takes over in the US a year later, and things more or less go back to normal, except that everyone is starting from zero since they had to liquidate all their savings to put food on the table when hyperinflation made a loaf of bread cost $23 million or something like that near the end of the year. Or I shouldn't say everyone, because Jane may have actually been able to save some of her money. The collapse of the dollar would almost surely have wide-reaching effects that would impact more than just those who happen to live in the United States. But that doesn't necessarily mean that every other currency or economy totally implodes. And as things progress, Jane may be able to get an idea of which places are handling the crisis best, and potentially even move herself and her base of operations to that new location. That way she wouldn't have to pay $23 million for a loaf of bread, she could just hand over a few euros or whatever currency the place she went to uses. If we look ahead 10 years, to the 30-year mark of this scenario, assuming nothing else happened by then, we'd see that after losing their entire savings, John and Bob have a net worth of approximately $84,000 and $70,000 new dollars, respectively. If we assume that Jane also lost all of her savings before managing to escape the worst of the crisis, we'd still see that she managed to come out way ahead of the others due to picking up various key skills and lessons throughout life. As a result of these earned advantages, she commanded a higher income when the new dollar took over and amassed a net worth of nearly $850,000. So you can see how becoming anti-fragile, beyond just your investing portfolio, could lead to a better outcome even if you don't manage to avoid the crisis itself. But again, to end this video, I do want to say that these negative Black Swan events are, by definition, incredibly rare. And that's worth considering as well. In researching for this video, I came across a question that really made me think, and it went something like this. How much money would you be willing to pay to eliminate a 1 in 2,500 chance of immediate death? That really puts things into perspective, at least for me, once I translated it into my investments. Because historically speaking, we've had market corrections about once every 10 years or so. That's about once every 3,650 days. And only a few of those crashes have even come close to wiping out half of our portfolios, as I detailed in my previous videos on stock market crashes. So if we look at it that way and ask, how much would you be willing to pay to eliminate a 1 in 2,500 chance of experiencing a market crash? What would your answer be? Mine would probably be a little, maybe a few percentage points of my portfolio, but I'd rather have most of my money in investments that I think are going to see decent growth in the future. Because if there's a hypothetically 1 in 2,500 chance of the market crashing, or whatever odds you want to use, that also means that there's a 2,499 out of 2,500 chance that nothing out of the ordinary happens at all. And I like those odds. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.